Uninvestible became Investible. So, all right, we're stuck here, man. Oh. Let me try using this. How does that work? Okay, good. We went through this. Everyone saw the main keynote presentation, so we don't have to go through this again. The podcast videocast, I would strongly suggest that if you didn't write it down, Hedge Fund Tips with Tom Hayes. You can find it anywhere you get your podcasts, or on YouTube is best. And the reason it's great on YouTube is because I go through 10, 20, what do we do, like 50 pages of data, charts, fundamental stuff, macroeconomic stuff every single week. So if you can see the charts when I'm talking about demographics, if you can see the charts when I'm talking about earnings, it's helpful. If you listen, it's great too. I know people like to exercise and walk around while they do podcasts, but you'll get significantly more value doing it that way. Welcome. We'll talk about this. I can't overemphasize these 4 points, and I know I did it in the previous presentation, but Owings Corning, the only thing I have to look at is the balance sheet. So how much cash do they have? How much debt do they have? What's their free cash flow to service that interest payment? And when do the different debt maturities come due? And if you can get comfortable with that, if you see the free cash flow trends are pretty stable, then yeah, it's a home run. You might even buy a few more shares at that level as well. Yeah, exactly. You know what? Go to hedgefundtips.com, click on the contact button, and you will see that you can write in your name, and you'll see click AMA for Ask Me Anything question. At the end of every single podcast, I take questions from the audience. So I'll get like 10 to 12 different companies per week, and I'll pull up the chart, I pull up the balance sheet, I pull up the income statement, I pull up the cash flow statement, and we go through it step by step. And I say, that's a great question. Here's why I would definitely look deeper at this, because this is a great idea. Here's why I would pass. And I do, like, in the last half hour, I do like 10, 12 of those very, very quickly. Well, actually not very quickly. Sometimes it runs for like a long time. So that would be a great place. Send that in so you will be the #1 Ask Me Anything question. And we're doing it early this week because I'm going to be in Dubai visiting a client. So we'll have our podcast on Tuesday. Okay, fantastic. Management is imperative. We have a company called, which we're not going to talk about today, which now we are, because you guys stayed the extra hour, called VF Corp. Anyone familiar with VF Corp? They've been around since 1890 something, 93, 95, 125 years. What they have a DNA for doing is buying and selling brands. Okay, so right now the brands in their stable are North Face, Timberland, Vans, okay, a company called Vans, and Vans has gotten hit extremely hard because they oversupplied during COVID. It was super popular. Everyone bought 3 pairs of Vans, very similar to Nike with the Air Force Ones, and the Air Jordans, and then it went through 3 years of decline. They brought in a new CEO. His name is Bracken Darrell. And the thing you need to know about Bracken Darrell, and I'm trying to emphasize this point about management. Bracken Darrell has a background at Procter & Gamble, at Old Spice. He's a brand manager. He's exceptional at it. He came into a little company called Logitech, okay? And this is the cancer-curing products that they made at Logitech, okay? Complete commodity product. Nothing revolutionary about a mouse or a webcam. He came in when the stock was down 82%, just like he came in at VF Corp with the stock down 82%. In the next 10 years, it was a 28 bagger. $1 million became $28 million selling this that you could get anywhere. Why? Is that a Logitech? Okay. Because he understood branding, he understood operations, he understood supply chain management. He's a winner. You want to bet on the jockey. So you may say, oh, Vans will never come back. Bracken will bring it back. He's worked through the channels. Now he's going to ramp it up. He's going to start bringing in the creators and the influencers and the whole marketing plan. You're going to see massive action. North Face is a recovery on China. It's doing well. Timberland, the same thing. So this is the type of bet. So when you're buying a stock down, and what did he do? He sold off Supreme for over $1 billion to pay down debt to deleverage the balance sheet. Why? To get multi-years of runway to run the turnaround plan and not get stopped out in the meantime. So that's the type of things that we like to look at. So near-term catalyst, et cetera. The key with these is the temperament. So I'm known as Turnaround Tom because I like to buy good businesses when they're marked down. But you have to have a certain level of ice in your veins. So like I keep going with the nickname that people gave me, but they're starting to give me the Iceman name, okay? Because they've seen me with stocks down, and I'm like, yeah, what's the problem? People are like, are you sure we should own this? And then like 4 months later, we were buying Vornado during the mini banking crisis. What was that, March of 2023? And they were throwing banks, baby, out when Silicon National Bank collapsed, and they were throwing out everything with the bathwater. The last thing you could talk to people about buying is an office REIT. Okay, I mean, but what did we do? We saw the dislocation, and we picked the highest quality business in the most dislocated market. So if office was going to be destroyed, which there was a compelling case for that to happen, which by the way it hasn't, which was the camp we were in, but we had to assume that it was going to happen, that we weren't smarter than 99% of people that said office was over. Who would be left standing? There would be some offices left. And what would be left would be the highest quality in the basket. And that's what Vornado owned in New York, all the best locations, et cetera. And then I could bet on the jockey, Steve Roth, multi-billionaire. Everyone I spoke to that knew him said the same thing. The guy's like 80. He will not die until his stock is back at all-time highs. I can assure you that. And that's what I got from, and I met this guy in 2010 at an idea lunch. And this guy was no nonsense. You have to know who you're betting on, is what I'm saying. You need a good quality business, a stable balance sheet to get through the downturn, and a good jockey to turn it around, okay? And the temperament to wait it out. And this temperament comes also, how many of you trade on or invest on margin or leverage? Yeah, so that's where you get stopped out. Because if a stock is temporarily down 20% against you, you might be down 40%. And you might have relinquished the decision to someone else called a margin clerk as to whether or not you could continue to have ice in your veins and stick it through until Bracken Works turns your $1 million into $28 million with nothing breakthrough here at all. Or if the margin clerk takes your money and sells your shares down 40% to a guy like me who's sitting in cash waiting for the shares. Okay? So you want to be on my side of the table, not that side. And the way you guarantee that is very low to zero margin. If you buy these stocks right, you will make more than enough money. You don't have to get... People who get hurt are people who try to get rich too fast, okay? When you slow it down, and the older you get, I know I look young, the longer my time horizon is and the wealthier I've become. When I was young, I wanted to be on margin. I wanted to get rich and make $1 million in a week. If I just buy these 0-day options and the market goes up 5%, I can make up, 10 million, whatever. And you wind up wiped out. And most people don't make it through that, and they're out. And if they just understood the right principles at the beginning, buy great businesses when they're at good prices, and wait. And don't be on margin. Don't give your decision to wait to the margin clerk who's going to make it the decision for you. Small portion, that's okay. Even Charlie liked a little bit of leverage. So Charlie Munger, that is. So that's that. That's temperament. What does uninvestable mean? The term uninvestable is music to our ears. It tells us that an asset or market has become perceived as so uncertain, so risky and fearful that it's easier to slap the label uninvestable on it, regardless of the fundamentals or valuation. That's critical. That's why Jeff put it in a different color font, okay? Regardless of the fundamentals or valuation, just to avoid the scrutiny, headlines, and career risk of going against the crowd. So most people are structured, most active managers are what we call closet indexers. Their whole job is to collect assets and stay in business. Because if they collect assets and stay in business, they have an annuity that goes up over time in perpetuity, because what happens? The market goes up over time in perpetuity. So if they don't zig too far from consensus and they have a down year, they get to keep their job because they didn't do worse by taking an unconventional bet. You, as individual investors, don't have those constraints on you. You can buy and underwrite an individual business like we talked about in the main room, and you don't have to worry about the short-term volatility, the short-term mark-to-market, the job risk that some of the managers, the closet indexers have, and why they stick. What closet indexing means is that they hug very closely to the index that they're measured against. So most managers are measured against the S&P. You'll notice that the top 5 weights of the S&P are X, Y, and Z, Mag 7 mostly. You'll notice that most active managers have the same stocks. Okay, so you're just paying more fees for effectively the same outcome. So we run things very differently, very similar to how Warren Buffett managed money for outside clients before he rolled it into the public company and had different types of constraints. So he was doing a lot more turnarounds, a lot more quick doubles and triples in his private partnerships than he was able to do in the big, because once he got the insurance float, he had too much money to put to work that he couldn't be quite as nimble 2-3 years. He was more interested in 10 years or forever if he could do it, because that insurance float just kept coming in and coming in and coming in. Okay? Different asset classes and sectors have been deemed uninvestable many times throughout market history. Financials after the great financial crisis. What was the best trade you could have possibly made after the March 2009 lows? You know, financials, Citibank, Bank of America, JP Morgan, etc. They were completely, quote, uninvestable. People kept waiting for the retest of the lows, etc. Tech stocks following the dot-com crash, and energy during the pandemic. Does anyone remember when energy prices went negative? In theory, they would pay you to take oil from them. Okay, you can't make this stuff up. So we'll tell you what we did during that. Uninvestable is often profitable. Taking the opposite side of most crowded trades historically has generated excess returns averaging 7 to 19% annually over periods ranging from 8 to 22 years. Since 1994, Morningstar's unloved sectors, those with the most outflows in the prior years. Remember in the previous presentation I talked about the last shall be first. That was our theme going into this year. The worst performing last year, international, non-magnificent 7, value. Going into this year, those were our themes, and those have been the big outperformers this year. Okay, so with this, Morningstar's quote-unquote unloved sectors returned 10.96 annually, nearly doubling the 5.57% from the quote loved sectors, i.e. the ones that had the most inflows in the year before. Okay, it's just human nature to want to chase what's already worked because you feel like it's safe, it's already working, it's not risky, but actually those are the riskiest things, unfortunately. And that's why you see this divergence of underperformance. So we look back here to 2000 and we got here, basically, what is this? It's a little blurry, but this talks about oil relative, energy stocks versus the rest of the market, talks about tech stocks versus cash, Talks about energy stocks pre-Great Financial Crisis when they were on that run. And you can see these extremes always work themselves out. So everyone gets excited. So what do you think would be most loved right now? I'm asking you. I don't know the answer to this question. What do you guys think everyone's super excited about? Go ahead. Semiconductors, okay. Yeah, certainly last year, and NVIDIA peaked at June 20th. I remember because we wrote an article on June 20th. You can check hedgefundtips.com. And the thumbnail of the article was a picture of Jensen Huang signing a fan's brassiere. And I knew that was the short-term top. I've been to this movie a few times, and the stock has actually not made new highs since that point. It may go on to make it, but that's almost a year of dead money. And it had quite a big drawdown, maybe 40% from that point at one point, 35, 40%. Okay. So semiconductors, anything else people are super excited about? AI, yeah, a lot of hype in AI. And I think all that stuff is going to come true. The question is on a company-by-company basis, are you already paying for the best case scenario if everything they say comes true is already going to be true if you're paying 100 times sales for a stock? You know, that's pretty amazing. If you went to buy the local car wash and the seller is like, yeah, I'll sell the business to you. And you're like, okay, what did you do last year? And he's like, well, we did about $1 million, about $80,000 a month. And he's like, all right, that's pretty good. You're thinking, all right, what did you earn? Well, we earned about $300,000 on that $1 million of sales. Well, that's a pretty good business. You know, you might offer him $1.5 million, $2 million bucks. But he comes back and he says, yeah, we're going to grow like crazy. We're going to buy up every single thing. We want $100 million for that $300,000 of earnings power. And you may say, yeah, this guy's pretty charismatic. He could probably buy 10 more. Maybe he'll buy 20 more. But if you pay $100 million, I guarantee you, you're already paying for the best case scenario. So if he only buys 2 more car washes, you're going to lose an awful lot of money if you pay him $100 million. And you probably lose half your money even if he does buy every other car wash that he's talking about. And that's what you have to be careful of. You know, when God was, does anyone know what FOMO is? Fear of missing out. So I think it's genetic. And I think when God was handing out FOMO genes, he passed up Tom Hayes, okay? Because, you know, people, I got rich on Bitcoin. I'm so happy for you. That's great. It's outside of my lane. It's not what I do, okay? I got rich on NVIDIA. Congratulations. I'm so happy for you. It's outside of my lane. I just like these double, triple, quadruples, great businesses. I can sleep at night. Boeing at $130. Disney at $85. I don't need to think about these things. I don't need to stay up at night staring at the ceiling. Is Disney going to stay in business? Okay? The way it works in America is if you don't bring your children to Disneyland, or World, at least 2 or 3 times, Child Services comes to your house, they take your children, and they take them away, and they give them to new parents, and they lock you up for being an abusive parent because you haven't taken your children to Disneyland. And that's never going to change, okay? The parks, the cruises, they've got 180 million streamers, which is half of what Netflix has. Netflix has like 3 times the valuation. Oh, and by the way, we got the parks, we got the cruises, we've got the ESPN growing like wildfire. So things like that. Moving along. Okay, case study 1. And you can go on hedgefundtips.com and see every video cast we've ever done, every article we've ever written, and see what we were saying when we did. And you're like, well, what does that help me to see you got things right in the past? How's it going to help me in the future? Well, it might say to you, like, if he's consistently done pretty well, it might make sense for me to listen to the podcast and, you know, get some value for free moving forward and prospectively. And am I going to be right about everything? No. Am I going to be more right than wrong? Yeah, you bet. Okay, because the framework we use is pretty hard to screw up. Okay, pretty hard to screw up. It's really what it comes down to. So energy was left for dead in 2020. It had been the worst performing sector of 2019. Lowest S&P weighting on record at 3.5%, highest short interest in nearly 20 years, and it was trading at less than half the market multiple. If you want to talk about uninvestable and career risk, if you were a pension manager, if you were a money manager running money for pensions and you owned an energy stock in 2020, you were probably getting a pink slip. Because it was all about renewables, it was all about, we're gonna, put up all these wind turbines and solar panels and all this fantasy land stuff, which is great. We need all of it, and we need more than ever, natural gas, et cetera. But it had gotten so extreme, and the boat had shifted so far, and we said, this is a problem, but how do we benefit from this without taking abnormal risk? And what I thought about was, one, I thought it was ridiculous that we weren't going to need energy for the next decade or 2 decades. I mean, you had to buy some of the story. It was so pronounced. It was so strong. The sentiment was so uniformly convinced that we were not going to use oil anymore. And we were all going to be in electric vehicles. And I said, what if they're right? How do I participate and still make money? And I said, let's just buy the one that will be left standing. If they're right about everything, one of them is going to be left standing in the transition. Let's buy ExxonMobil at $33 a share, paying a dividend. World is shut down. Not a complicated decision, because if Exxon goes, I have a lot more to worry about than my stock portfolio. Because if we're not pumping energy and we're not keeping the lights on and people have stopped moving, last thing I'm going to be worried about is my stock portfolio. So, yeah. That's a good question. I don't. 6 or 7. You remember?
In the 40s.
Yeah, 6 or 7. You bought it in the 40s. Yeah. So it must have been 8. So there was a real risk they were going to cut the dividend, and I fully accepted that. I mean, any stock that drops that much, I'm not buying for the dividend. I'm buying for the turnaround. Every now and then, they keep the dividend. Like we didn't have time to talk. Jeff had noted 4.4% dividend yield on Stanley Black & Decker right now, and the stock is down 80%. So might they cut it? Yeah, but the fact that they've taken almost $2 billion of costs out of the business and the revenues are starting to reaccelerate, you probably get that. Lock it in. They keep growing the dividend over time. They've cut it a little bit. Yeah. So, so what was it at peak, right? Like 8% or something? Yeah, when the stock had dropped. So that happens in those situations. But once the business stabilizes, what do they start doing? Increasing the dividend again. So on your basis, it starts to really compound. I mean, Buffett gets annual dividends close to the total amount of basis he invested in Coca-Cola in 1989. It's unreal. And it keeps growing every single year with it. Adjusted, it's complicated, but cheaper than now, I'll put it that way. Okay, so that was Exxon, and we didn't get the exact bottom. I think the bottom was $25. We got it at 33 blended, and we didn't get the top. I think we sold it below 100. It's now 105. But, it wasn't a 10-bagger. It wasn't NVIDIA making 50 times your money, but that was like, you don't have to think hard about. Another one we did during the COVID was Wells Fargo. Wells Fargo, 3 times in history, it traded below 50% of tangible book. Okay, we built a huge position at $25.10. And if the world was going to end, our view was that probably JP Morgan, probably Wells Fargo, and possibly Bank of America would be left standing. Okay, so JP Morgan didn't come down enough that we felt like we were getting paid for the amount of risk we were taking. Wells Fargo came down enough that we're like, yeah, this is not going to be hard. And it went up to the high 50s very, very quickly, got out at 57, and that's that. But we didn't have to think hard about that, because if Wells Fargo ceased to exist, I like to say that the end of the world only comes once, and if it's now, don't worry about your stocks. And if Wells Fargo ceased to exist, that would be as close to the end of the world as you could get. So that was a no-brainer. Yeah. We hold stocks between 1 year and 5 years, but I'd say 3 years is kind of the average turnaround period. Yeah. Some go super fast, like Vornado was a quick double. That was one of the few that did it in less than a year, and that was frustrating because we had to pay taxes, but it wasn't something that was a hold forever stock, and we're like, you know what, take the win and move on. But usually it's going to take well more than 12 months, so we're comfortable to, like Cooper Standard, we started building at $5 and change in May of 2022. That's now a 5-bagger off those, but we're 3 years in, and we don't even think the story's begun. We think it's going to double again from here. So that's going to take probably 5 years till we're fully out or getting out. But the return on capital is insane. So we're always looking at the trade-off for internal rate of return. Has to be in excess of what we're measured against. So if that time creeps too long and it starts to impact our IRR, that's something we're cognizant of. And by the same token, if the IRR is insane in a short period of time, we have to harvest some of that. It's a balancing act. They were asking earlier, what's going to happen to analysts with AI? And I said, the mediocre ones are going to be toast. But that type of analysis, like it can be done by machines, but there's so much nuance. I remember when I worked at Cornwall, and I'd sit down with them and I'd pitch them on an idea, and my pitch would be like, I don't know, 5 minutes. And then the guy who was played by Brad Pitt in the movie, he would start asking me questions, and it would be like 4 hours. And he's like, how come you just don't say all that stuff that's in your head? And I was like, I don't know. It's just all processes like in my head all the time. So I just give you the summary. And I hope you're thinking about all those things that I'm thinking about. And like he taught me to like take that stuff that's whirling around in there and kind of get it out a little bit more so people can understand it. I'm getting there. I'm a work in progress. So better investor than communicator. Big tech bet in the 2022 bear market. Two things people think about Tom Hayes. Number one, they think I'm a permabull because they know me publicly since it's been time to be a permabull. And number two, they think I hate tech and I only buy factories and boring businesses. And the answer is, it couldn't be farther from the truth. I buy what's on sale. That's high quality when it's on sale. And in this recent tech pullback, I would call it a pullback for Mag 7. The reason I didn't jump all over, if you had put a gun to my head in early April when we were buying a ton of stocks, I think I even mentioned on the podcast, like I could see a scenario where Mag 7 really moves. I don't think the underlying earnings power prospectively, because of the amount of capex they have and how that's going to crowd out buybacks, is going to justify them trading above the top of the range. So on that basis, for me to take that risk for only 30 to 40% quick return is not worth it. Like if something can't be a double or triple or quadruple in a reasonable amount of time, handful of years or much less, I'm not allocating $1 of capital, because I think in any investment, there's things you can know and there's things that you don't know that you don't know and maybe can't know. How many of you knew United Healthcare was committing Medicare fraud? If they were, we don't know yet. You're going to stick around and find out? I mean, if you're holding the stock and you're like, well, I'll bet they didn't commit fraud and the DOJ is just going on a fishing expedition, it's like, that's kind of gambling. I had clients ask me, because I like to buy stocks, I was like, under $200 a share, I might be willing to assume that gambling risk, but not yet. That could be a quick recovery, but that goes in my too hard box. Like, how can I have an edge? So the point I'm making in that context is that's why, you know, our highest conviction idea is not 100% of the portfolio. Now we're concentrated 8, 10, 12 stocks, but we accept the risk that any one of those stocks. So when I size positions, here's another filter besides owning the entire business, is if this position went to 0, would they take me out on a stretcher? And if the answer is yes, the sizing is too large. And I'm being a cowboy. So I'll never take that risk. If the answer is no, the other 9 positions in the portfolio are all going to be doubles and triples. If this goes to 0, it doesn't matter, I'll still outperform. Then the answer is yes, you're sizing it correctly. And you have to go into that assumption in every single investment that there could be things that you don't know that you don't know. UNH is a monstrous business. This is not some shyster, you know, insurance agent on the corner selling away some policy that they shouldn't have sold. This is like serious stuff. And you have to have that assumption. So if everyone is crowding into one stock and you're like, oh, if I just buy that stock, that's how you really get hurt. So even no matter how good your research is, no matter how high your conviction, no matter how high the margin of safety is in the business, there can always be a risk that you don't know, and there's no way you could possibly know, no matter how good you are as an analyst. It's just a black swan.
You think they're in the Dow, sorry, they might get kicked out?
I don't know, but if they did get kicked out, it would take a while, and those stocks have a tendency to outperform in the next 12 months, so that would probably be a trigger for me to take a closer look, I gotta be honest with you. So 2022 marked the 3rd worst year ever for tech, only behind the dot-com crash and the great financial crisis. Nearly $2.5 trillion in market value was wiped out, and tech layoffs at their highest level since 2000. The post-pandemic capex and hiring spree in tech was quickly replaced by the fastest Fed tightening cycle since the 1980s, ending ZIRP, zero interest rate policy. And we've covered that in my panel on Friday. We covered that a little today. If you're going to be exclusively growth, because that's what's worked in the last 15 years, you are making an implicit bet that you believe rates are going back down to 2% or 1%, because historically that is when growth outperforms. And you're like, well, there haven't been that many periods that rates have been at 1% or 2%. Well, newsflash, there haven't been that many periods where growth has outperformed value. It just happens to be the last 15 years. You know, it's funny. I talked to a new client. I said, let's turn this around. You want me to grow your money, right? He's like, yes. I said, how about if we did an exercise and you came to me and you said, Tom, I've got $10 million. I want to see how quickly you can lose it in 24 months. I'd say, no problem. Here's how you do it. All you have to do is buy a basket of 20 stocks, trading at 10 times sales or greater, and making no money. And I guarantee you're going to lose 90% of your money in the next 24 months. Except the last 15 years, that basket of stocks has outperformed the S&P 500. Every other 10-year period before ZIRP, you were guaranteed to lose 90% of your money. That was like a no-brainer. And now, that's all anyone's excited to buy.
What's the difference between what you do and an RIA?
An RIA usually is doing like estate planning. They're doing when are you going to retire? What, you know, planning goals for your kids. I come from a hedge fund manager background, so we run the same strategies. Concentrated portfolio, 85-90%, 8 to 10 to 12 stocks. 10 to 15% is in a derivative overlay for excess returns without drawing major leverage. And we also use that bucket for hedging and dampening volatility from time to time when we think the market is dramatically overvalued, but there are no companies that we're ready to harvest yet. We'll use that to do some hedging as well. Okay. So we saw the panic as a generational, post-pandemic capex hiring spree. We saw that as a generational buy opportunity, picking up Amazon during its worst year since 2000, and Google after both were cut in half that year. This was Google and Amazon cut in half. Now, and investors puked in the hole, and you couldn't give away a tech stock because what? Free money, all the VC money crowded in 2021. chasing ridiculous ideas and ridiculous deals that weren't making money. As you got forced liquidations and the business plans didn't play out, these were a source of funds for many private investors. Those were a double in about a year and a half. Both stocks are essentially flat since we exited. Okay. Now, the most uninvestable opportunity ever is China. And this is one of the category that takes longer than expected. This has not been a Vornado, okay? This has been a multi-year thing. We started in the hundreds, and we bought all the way down to the 60s. And that was a scary day, I remember, because it went to 59. Rob probably remembers it, remembers the podcast. Rob's been listening to the podcast for 3+ years. Jeff probably remembers it. And we brought our basis across all accounts down to $82 and change. And the reason we were able to do that is because no leverage. No one took the decision out of our hands as it was collapsing, because Xi Jinping was soldering people into their homes, in their apartments, so they couldn't leave their apartments during COVID. I mean, but they were still generating $20 billion of free cash flow, had $80 billion of cash on their balance sheet. So did they have the runway? Yes. Effectively, no net debt, because they had $80 billion of cash, and I think it was like, what, $18 billion of debt at the time, something like that. So they had the runway, they still had the growth, they still had the free cash flow. What they didn't have was investor flows, foreign investor flows. They didn't have excitement, they didn't have FOMO, but that's when we like to buy stocks, okay? You can see all the headlines. There were 35 consecutive, 135 weeks of negative headlines about China and Alibaba, 135 weeks from one single journalist. Okay? Now, I won't say anything about this journalist, but I will say it would be the equivalent, where this journalist was from would be the equivalent of having a Palestinian write articles about Israeli breakthrough tech companies. Okay? You're not going to get a positive article out of this one. And it was just going on and on and on. So these were uninvestable for nearly 3 years, and she wasn't the only one. Every journalist and every sell side and everyone investor was negative on China. So let's take a look at perception versus reality. Okay, you know the story about the peak is when they canceled the Ant Group IPO. Okay, and Jack Ma went into hiding, became enemy number one because he spoke poorly about Xi Jinping. And we had the threats of delisting the stock in the US. They had to go through the PCAOB report. They passed that with flying colors, only to get new headlines during China negotiations this year about delisting, because Rick Scott has a problem with Chinese companies. Because the new SEC chair was very tight on votes, and Rick Scott said, you want my vote, you got to look into this. So we switched all our shares from US listings to Hong Kong. I think now that the Chinese negotiations are going well, I think that was a leverage point that they were playing, because if they actually delisted US ADSs, all they heard is US investors. They would torpedo $800 billion of US investors' cash. Chinese don't get hurt. They don't own it they don't own US ADRs. So I think it was on purpose, with the intent to kind of threaten the Chinese government that if you don't come to the table, you're going to lose access to the US capital markets. That's my take. That said, I made the move anyway to protect my investors' capital. That's my number one responsibility. We still own derivatives in the US because that's a risk we're willing to assume in that 10% bucket. Any position we put on for excess returns, we'll accept that risk, because the underlying stock position will more than make up for that many-fold times. But we want to keep that expression because we can't replicate it in Hong Kong. We can replicate the stock position in Hong Kong. So for simplicity's sake, all this is probably noise. The odds of them delisting are very low in my opinion, but it's not nothing. So if you want a more as riskless as you can get, while still assuming any risk with investing, you can, through Interactive Brokers, you can just buy the ticker 9988 instead of buying BABA. Okay? So China's rapid economic expansion has been driven by increased manufacturing and production. While we're relying on an investment-led growth model, consumption makes up 55% of GDP in China compared to 70% in wealthier nations. US households consume 12 times the nominal dollar amount of their Chinese counterparts. China's made boosting domestic consumption a top economic priority in the last 12 months, aiming for 70% by 2035. To put it in perspective, China's 2024 GDP was $18 trillion with consumption at 55%, which is $10.3 trillion if they grow 5% this year, and then slow to 3% annually through 2025. Hitting the 70% consumption target would mean 18.5 trillion in annual consumption by 2035. That's an $8.23 trillion jump. Alibaba has 40% of the Chinese e-commerce market. So this is what we call, ladies and gentlemen, a toll taker. Okay, the government has now mandated that consumption is their number one priority, and Alibaba is going to get a piece of that action that the government's going to push. Okay, and when the Chinese government makes something their priority, you remember solar panels, you remember EVs. Okay, they're 60% of global EV markets, and now it's consumption. They want to get that 20 trillion of savings circulating in their market so they're less dependent on export. On the flip side, the US, you can see it makes perfect sense that we would do a rebalance because we have we want to increase our manufacturing. This is the red line. Okay, this is consumption, this is manufacturing in the US, this is consumption in China versus manufacturing. They just want to kind of normalize, bring this down a little bit, bring this up a little bit, bring this up a little bit, maybe keep this up, maybe it goes back a little bit. And that's a natural, healthy thing. And that's the purpose of the trade talks. So politicians will always do the right thing after exhausting all other options. And that's exactly what Xi Jinping did. He did a policy 180 after youth unemployment topped 20, it was actually 25%, some say 40%. But more than that is when unrest hit the streets. And when we saw the data on the number of protests, we knew we were at an inflection because either he changed or they would change him. And he changed and he pivoted and it was done overnight. He's been stimulating ever since. The numbers are slowly improving in fits and starts. And for Baba, they're improving materially. Even this most recent earnings report, I wrote some notes that I left on the other stage, but Taobao and Tmall, which is their retail, up 12% year on year. That's hard when you're number one in the market to get that level of growth. 12%. Cloud business, number one. Compute power, they've got 40% of the cloud market, Jeff? 36%. Okay, so they're the number one cloud provider. Compute. Beijing's pivoted from tech crackdowns to open support. Jack Ma's public return and front row handshake with Xi sent a clear message. The private sector is back in favor and seen as a key partner in China's economic future. That was not the case when we bought the stock. Okay, that's why we have a blended basis of $82 versus 125 or 130 wherever it is now, and going over 200 plus. Xi sees private tech as a key to his 2030 goals to lead in semiconductors, energy, AI. China needs more entrepreneurs on board, calling this the right time for private enterprises to fully display their talents. After 2030, he may go back to being unfriendly, but right now he knows in order to stay in power and deliver, he needs to do this. So China's stimulus plan targets the 20 trillion in household savings. People have been saving money because they've been scared because of the policies. Policies are changing. The consumer is thawing, and that money is going to wind up. Action plan for boosting consumption includes a 4% budget deficit, moderately loose monetary policy, reserve ratio requirement cuts, lower rates, trade-in programs, and state-backed stock buying. They're actually, like the Japanese, in the market buying stocks to prop up the market right now. And if you want to move the market, what's the number one stock you want to buy? The heaviest weighting in all the indices, okay? Your Alibabas of the world and your Tencents of the world. If you move those stocks, you move your market. If you move your market, more FOMO comes in from outside investors, and that's explicitly what they're doing. They're not even hiding it under the table. We are buying stocks. So do you want to get in front of that freight train or ignore that freight train? The Japanese did it. You saw what happened to their markets 2 years ago, okay? So you see that they're running the highest deficit. They're running their deficit at the highest level in decades. This is deficit spending to spur growth. M2 money supply globally, if you look at pull up the chart, go to Google when you go home, you're going to see that it troughed and it's going straight up again. And all of that increase in money supply, all that stimulative stuff, it's not coming from the US. We're cutting spending. It's coming from China. M2 money supply, that equals liquidity. That means asset prices go up, and it's all centered in China. So if you don't have, I understand being nervous about China, but if you don't have like some exposure, even if you buy an ETF, my friend Brendan Ahern runs KWEB, which is a China ETF. I think 86% of his holdings are held in China. He still has like 14% in the US that he can't get in China. But for me, this is the best asymmetric reward. And if I'm going to risk $1 of capital, I need a double plus, and this is where you get it. If you own a basket, it's very hard to get those type of returns. Return of foreign capital, foreign inflows remain at historic lows, very similar to energy in 2020. The weightings of China equities in all the international funds, the flows into the sector, I don't know if this is worse or energy was worse in 2020, because in 2020, the narrative was so clear, like windmills and solar panels, and like, if you use oil, you're going to hell. I mean, that was basically permeated everything. I think with China, people are just a little nervous until they see some price go up, is basically. All the analysts, there's one major sell-side bank, which I won't name, they were aggressively downgrading Alibaba at $60. And they're now aggressively upgrading it at 125 and change. The consensus price target has gone from like 80 to 175 now, and now there was another firm out on Friday at $190, and when it goes over 200, they'll all move it up to 250, and that's how it works. They blow with the wind. Opinion follows trend, okay? Foreign investor exposure to the world's second largest economy sits near record lows at 5%. Down from 14%. Remember when I was talking about the weighting of energy in 2020? It went from 10% down to 3%. That's usually the low, okay? When the weights drop by 66%, whether it's a sector within the index or in this case, China within the international index, you can see here the extremity of where we are right now. It's very much like you'd have to go back to 2021 to see that. Or you can look at, this was a monster rally in Chinese stocks when it bottomed out here, like it seems to be bottoming out right now. Yeah, go ahead. Pretty much every red day for 2 years I bought stock. Oh, we have size limits, so we'll never go above, like our biggest position ever. We did that 2 times. We did it with Wells Fargo during the pandemic. We went up to 20%, and that was a quick double. And we did it with Baba, and now Cooper Standard, because it's gone up 5x, has become a huge part of the portfolios. Huge. So we have to constantly assess the current weight as these things go up in price. I mean, Baba has now moved up from 82 basis to 125 and going, so it's making up bigger and bigger weights over time, so we have to constantly monitor it. But the answer to your question is, I don't think I've ever bought a stock on a green day. Yeah. stopped out in terms of what the risk I'm willing to take. All right, so this shows revenues, cash flow, and these are type of things I like to look at. This is just a page from Value Line. And you can see over time what's happening to the revenues per share, what's happening to the cash flow per share, what's happening to the earnings per share. And what's interesting is if you actually look at that, for good businesses, that line tends to be like in a bad period, it'll be flat. In normal periods, it goes like this. And then stock price goes like this around the actual fundamentals of the business. And what we try to do is we try to buy when price is here, but fundamentals are still here. And we try to sell when price is here and everyone's excited and there's headlines. And people who hated it down here are on stage in the main room loving it up here. You'll probably have some people pitching Baba next year at $200. If we have a presentation, if we have a money show, I would definitely say 18 months from now, there's going to be a speaker on stage pitching Baba over $200. It will not be me. I'll be waiting for him to get it over $250, and I will be helping out his audience get as many shares as they like. So write that down, put it in your Google Calendar. It's coming to a theater near you. All right, Alibaba's, we covered that. All right, I want you to understand this concept is critical. So we talked about fundamentals versus price. You can buy this stock effectively at 2014 prices. The difference today is that the revenue per share is up 1,100%. The cash flow per share is up 500%. The earnings per share are up 500%. And the stock is effectively flat. The one other stock I can think of that had experienced this type of improved fundamentals with no improvement in price until it all improved at once is Microsoft. Microsoft, from 2006 to 2013, they grew revenues by 112%. They grew cash flow per share by almost 200%. And they grew earnings by 120%. The stock did nothing. In the following 10 years, it was up 1,500%. And if you look at the fundamentals, everyone says, well, Satya changed the world, blah, blah, blah. His improvement in revenue per share, cash flow per share, and earnings per share is not much better than Steve Ballmer's was, except he got multiple expansion and the stock went up 1,500%. And that's what I talk about, opinion follows trend. You're going to see the same thing with Alibaba. You're going to see the same thing with Cooper. You're already seeing with Cooper Standard, is that when the price goes up a lot, everyone gets excited and they jump on the train, okay? And the same thing is going to happen. What's despondent now, despondency turns into euphoria. It's the extreme. Like Warren Buffett always taught from Ben Graham, the market is a manic depressive, okay? It's one day, the business is the same. In the short term, it's a voting machine based on emotions. In the long term, it's a weighing machine based on fundamentals. So that manic depressive, if you can buy stocks from the market on its depressive days and sell stocks to the market on its euphoria days, that's where you make your bones. Yes, ma'am?
So you're thinking about buying long out of the long-term option calls.
Yeah.
Calls that expire like in a year or 2 years.
Yeah, we tend to use that to enhance returns, but you have to have a core underlying position as your core position because you can't be certain about the timing of your view, even if it's a year or 2 years. Because look, you could have done that in Microsoft. You're like, wow, they've doubled their revenues, they've doubled their cash flow, and you bought those options in 2014. By 2015, it hadn't moved. And then from 2017 to 2020, you made 15 times your money. And the options would have been up 50 times. Yeah, but you would have gotten stopped out 2 or 3 times before that. That's why you start with the core position. So as the stock was slowly going up and your options kept expiring, you were making money and you could reload if you wanted to. But if you just do options, right, and you get the wrong year or 2 years, you're wiped out, right? So you do stock primarily and then add some excess for some excess returns in the way that you position it based on option pricing, volatility, and that type of stuff. But your thinking is correct, but just start with the stock. Don't try to get rich overnight. Buy the stock. I'm going to own this thing until it reaches intrinsic value. And if you want to add excess returns, do that. I think we're pretty much done. I want to open for 1 or 2 questions because we ran over. Just to give you an idea, ChatGPT is valued at $300 billion in its latest round. That's the whole market cap of Alibaba. The difference is that Alibaba generated $17.8 billion in net income this year. OpenAI is lucky if they do $13 billion of revenues, never mind earnings. Okay, so that's OpenAI is an example of euphoria. Alibaba right now is an example still of despondency. Sell euphoria, buy despondency. It's a good formula. China's the #1 global AI play. The most AI you can get for the least amount of money. Their large language models have been proven competitive and better than DeepSeek and OpenAI on many accounts. And for compute, they give pretty much every AI startup in China goes through Alibaba, #1 cloud player. They say, we need compute power. Alibaba says, no problem. We give it to you for free. Like every good drug dealer, give you a free sample. And then they say, just give us equity. And they have free equity in all the AI startups in China. So it's almost like an AI ETF by owning Alibaba. Cloud revenue up 18% plus. So all of them are hitting on every cylinders. We like a lot of outs. You got the e-commerce, you got the cloud compute, you've got the AI play. You have Taobao and Tmall play on the government initiative to get that $20 trillion of savings circulating. Alibaba is the toll taker. Middle class recovery play. And for the first time ever, mainland Chinese stocks could buy Alibaba through the Stock Connect. So imagine if you're getting 3 Amazon boxes at your door for the last 10 years, but the US government said you couldn't own couldn't own Amazon, and all of a sudden they said, you know that company you're sending all your money to and they send you boxes? You can own some equity in that company. And that's exactly what happened. Analysts estimate $20 billion in potential inflows from new buyers. I think we're at already $8 billion or something like that, just in the last 6 months, something like that. So the game's just beginning. You're getting another source of buyers until the foreign buyers start to step in on top of it. By the way, owning China as a pension manager and large asset manager was like owning energy in 2020. Now, if you didn't own an energy in the last year or so, you underperformed, so they all owned energy. So they sell the bottom, they buy the top. Opinion follows trend. Tariff exposure, less than 1% of Alibaba's $134 billion in revenue came from the US, so it's a non-issue. The delisting would only hurt Americans, and this is how you contact me. So a lot of you asked me, podcast name is Hedge Fund Tips with Tom Hayes. I recommend you watch on YouTube. You'll get more value, but listen if you like to walk or play golf. Twitter, @Hedge Fund Tips. TikTok, for all of you official Hedge Fund Tips. I'm very popular with the TikTok crowd. YouTube, Hedge Fund Tips is the channel. And that's my email and contact information. Any questions? Yeah.
Alibaba was their stated capital allocation. Stock buybacks, everything in there. And then Generac seems to have an interesting personality as you go with the hurricane season.
Yeah.
Everybody, they make all their numbers weather events.
Yeah.
Tell us a little bit about the process.
Yeah, I think for Generac, it is seasonal, and none of their guidance includes any type of extreme events, and there's usually always an extreme event at this time of year. So they don't put it in, so they what we call sandbag. They very conservative on the guidance. We started building that thing. We had a basis below 100. It shot up to 194. It's come down to 124. It's not changed our view on the stock. It's just how it recovers. The thing had a heart attack. You know, when you have a heart attack, you get off the table, you don't run a marathon, you go out, you walk around with the pole, you let go of the pole, you think you're okay, you fall on the floor, they're like, go back to the pole for a little while. I mean, 80% down is a heart attack, okay? So now they're walking again with the pole, and they're gonna try again, and then they're gonna do better. And this happens, it is a very cyclical business because in some of our video casts, we've gone through the cycles where they have the revenue declines and the cash flow declines, and then it starts to reaccelerate. But if you look at that slide I did in the last presentation, cash flow is nearing record highs, and the stock price is still down some 80%. This is like, Buffett talks about the fat pitch. Wait for the fat pitch. For me, this is a complete no-brainer.
Sorry, Bob, we just did allocation.
Yeah, so they've bought back. We skipped through the slide, but they've got 20 billion more on their buyback. They've been buying in tons and tons of stock for the last few years. They started paying a dividend. They just announced a special dividend. So we're not in it for the dividend. It's nice to see them returning capital. They're going to continue. The interesting difference between U.S. managers and Chinese managers, the Chinese, to their credit, were buying every share they could get their hands on below 100 in the hole. Whereas U.S. managers, after the stock's up 10x, they start announcing big buybacks so that there's liquidity for them to sell their own options. And it's a completely different mindset. So the Chinese buy low and sell high. The American managers, for the most part, when the stock collapses, they're not in the market buying. So we're happy that they're doing it. And their buyback rate is slowing in the 120s, which I'm very happy to see. I love that they were buying hand over fist in the 80s and 70s, and they still have 20 billion of authorization, and they will use that. But the time to buy for the company, because they're stewards of my capital as an owner, was to be buying when we were buying. And I don't think we're going to get material dips from here for them to buy in a huge part of the company. I think from here it's just going to keep pushing higher. Is my general view at this point. Like the pain is in the rear view. The majority of the pain is in the rearview mirror. I know because I lived it, buying on every red day. And now it's like that Microsoft chart where it's just like fundamentals are getting better, but all of a sudden people start to get interested in the stock and all that. It's like holding a beach ball underwater, like Generac. How is the cash flow getting so much better and the revenue is starting to improve and the margin starting to expand and the price is still the same as when they had negative cash flow? It's just you're holding the beach ball underwater, and once you let go, it just goes. When it comes all at once. That's the way these turnarounds work. So. Yes. I met Kathy. Kathy has a house next to in the town over from our houses in Connecticut. I met her in Tampa. She's a super sweet woman, like really approachable, nice person. It's a different game. I mean, that's not my lane. So for me to comment, she's trying to guess what technologies are going to change the world, and she might be right, and she might pick one, and that's 1,000 bagger, and then it will go up. I can't predict her ability to predict. I can't even predict. That's why I don't predict. I buy these boring businesses that I can sleep well at night that are quick doubles and triples. So I'm the wrong person to ask, but I hope so. I hope she does great. But it's not for me. Not what I do. Not for me. Yeah.
What are your thoughts on car manufacturers, especially General Motors and others that are trading well below their book value?
Yeah, great question. I like to buy the arms dealers, not the warring factions. So GM and Ford are going to be a race to the bottom in margins. They're going to start. Incentives are going to start going up. Volumes are going to start going up. Race to the bottom. You want to play in the companies that benefit from increased volumes and let them deal with the margin compression. Same with the home builders, in my opinion. So that's how we play it. I think your thinking framework is correct. I just think there are better ways to play that theme. Yeah. All right, cool. Yeah.
Talking about Alibaba, but there's also a concept that they're really check to margin range in like China baseline, which are actually, I guess, in China outperforming. I feel like think about like these other.
Yeah. Of those, if you put a gun to my head, I'd own Tencent for sure. And if you said you got to own a third, I'd say Meituan, but no one has a gun to my head, so I'm just happy owning Alibaba. So, but yeah, I've looked at all of them. Yeah. Yes. No, because Brad is one of the few people who can operate a roll-up properly. So what he does is he comes in into a fragmented business, rolls them up, applies technology. He's really good at applying technology to get cost synergies. He's not just like a private equity where he just cuts jobs and hopes that the business keeps running with half the people. He actually brings value add, operational and synergistic stuff, and then scale buying. And he's just done it so many times that he's one of the few people I would bet on a roll up, because he did it at United Rentals, he did it at Waste Connections, he did it at XBO, and he's just a master of doing this. So yeah, reasonable concern, but wrong guy. Yeah. Which guy?
Who was part of United Rentals?
Oh, Brad Jacobs has started QXO. It's a roll-up of building supplies to play the housing recovery. Yeah. Cool. All right, well, thanks for staying a few minutes late. I appreciate it. And hope you enjoy.